Welcome back to Who Builds Equity, where we're talking about building equity a little bit differently today. Let's talk about investing.
My name's Martha McKinley.
That's how it feels. I was like, this does feel weird. Like, I don't talk to you guys like this on a regular basis, but I talk to you normally all the time. But no, we're gonna keep it casual and just talk about the Simply invest because I feel like it's something that a lot of people are talking about. It's all over social media, investing. People want to invest. They want to learn more about investing. But when I get the opportunity to talk to a lot of people about investing, they're not actually investing. And that's for several different reasons. So, building equity through investing in the tools that we have to make it possible is something that I think everybody should be doing. And today I'm joined by Christopher LaVine and Martha McKinley from Marstone, one of Equity Bank's partners who works with us on many things, one of those being our Simply Invest platform. So, Chris and Martha, welcome. Can you tell the audience what each of your roles are with Marstone?
Awesome. Thanks, Emily. Well, we're psyched to be here and psyched about the Marstone Equity Partnership. So Chris LaVine, I'm one of the co-founders of Marstone and lead strategy.
Thank you. I'm Martha McKinley. I oversee our client success team here and implementations and get to work with clients like Equity and Emily. Thank you so much
Awesome.
for having us.
Yeah, thank you guys. So, I feel like a lot of people only put their money in savings accounts, and a lot of times I hear, and I'm sure you guys hear the same thing, it's because investing feels confusing or it feels risky or they think it's not for them. And savings is safe and steady, and but the growth is also a little bit lower, and investing has, more ups and downs and higher long-term growth. And that's exactly why Simply Invest exists, correct?
Yeah, actually, well, it's a really cool thing that you highlighted, Emily. So we did a study like 10 years ago asking people why don't they invest? And so it was a wide ranging group of people who are just out of college, just out of graduate school, younger, older, a pretty wide demographic. And I think it was order of magnitude about half the people weren't investing. And most of that was because they didn't even know where to begin. And so that was a decade ago. I think things have changed a little bit, but still people just don't know where to start. And so I think it's through programs like what we're doing with Equity, it's really getting the word out that it's actually much more accessible than people think it is.
Yeah, and I know for myself, I mean, I always thought that you had to go with like a traditional advisor, and that meant appointments and higher minimum balances that you had to have to start investing with them and higher cost. And all of that felt really intimidating and something that was really out of reach for me. And I think a lot of people feel that way. And then you have the alternative of, the DIY investing where you're choosing stocks and bonds and different things like that. And I personally do not feel smart enough to be able to do that. So that's why I think Simply Invest is awesome because, it's online, it's guided, it builds the plan for you. So there's no guessing or picking different things. And it's really a great option for beginners. So Simply Invest, why would you say that's a better starting point than an advisor or choosing those investments on your own?
There's really not like a right or wrong answer. It's really what's right or wrong for you, the individual. So a lot of people, when they look at investing, maybe they want to actually work with an advisor because they want that person to work with them to understand their goals and actually say, I'm planning for my kids' college, I'm planning for my retirement, I'm planning for this house. Help me achieve all these different things. I've got this pocket of money over here. I've got this 401k, IRA, maybe even like a pension. Help me make sense of all of it. And that makes total sense. There's a huge part of the population, though, that just says, hey, I've got a relatively straightforward investment picture. I know I need to save and invest. I just want an easy way to do it. I don't want to go out there and pick stocks myself. I don't even want to pick ETFs myself. I don't want to be in charge of the rebalancing or all that requirement. Is there an easy solution that I can be in control, but also have a trusted expert nearby? And so really that's what the Marstone Equity Bank Simply Invest partnership is. It enables somebody to come through and they can answer the question entirely digitally, go through the platform all by themselves. There is a help desk if anyone has any troubles or questions, but really the platform has been designed in a way that it reaches everybody, whether you're a total novice or an expert. And then it creates a customer configurable portfolio for that individual, which then is rebalanced as well. So I think one of the things that people also realize is that, hey, maybe I can buy this ETF or this mutual fund today, but what do I do in 3 months, 6 months, a year's time? And so what I think one of the cool things about this Simply Invest program is that it's constantly monitored by a team of experts to really make sure this portfolio continues to reflect your risk tolerance. And again, mine's different than Emily's, different than Martha's. And so that's what's the really great thing about a platform like Simply Invest is no matter where you are in your arc of wealth creation, there's a part of the platform that is you can use and be in a great situation that's right for you versus, again, anybody else.
Yeah, I think to just add on to that, it's not that one is necessarily better than the other, like Chris said, but often working with an advisor has a barrier to entry. There is a minimum that a lot of people just don't have. They might have $500, they don't have 100,000 or 500,000, and that does not mean that you can't invest in the market. And I think that's one thing that we feel really strongly at Marstone, and I know Equity feels this way too. We want to meet you where you are, and we want to give you the same access that other people have to the markets. And so Simply Invest is doing that. Like Chris said, yes, you're not working with a person or an advisor, but you're getting so many of the benefits of that. So someone's monitoring your portfolio daily. They're looking at your risk tolerance, they're rebalancing and trading it based off of that. And I think that we feel just start, and Simply Invest gives you a really simple and easy way to do that. And I think that that's one of the most important things. And just going back to what you said, Chris, earlier about how, things have changed in the last 10 years, they absolutely have. And there's so much more access to markets, but there's so many more players that can make it really confusing of like, where do I start? What is the difference? I hear self-directed all the time. What does that actually mean? And I think that Simply Invest gives you a way, and investors a way to start really honestly simply, and but having all the benefits of that, of someone monitoring it in a really, I think, elegant way. So
You're absolutely right, Martha. That's a really great point where 10 years ago, there probably weren't that many options and people just didn't know where to begin. And now all of a sudden, there's just so many options. So people, again, are almost paralyzed by all the opportunity.
totally,
So
totally.
that's where I think really somebody like an Equity comes in with that community relationship and saying, here, I've got a relationship with my community bank. I know and trust this institution. Here's a Simply Invest program that they're rolling out that really helps me, again, to start simply investing. I think that's really great name that Equity's come up with for it, because again, the key to investing long term is just starting as early as you can and staying with it for the long term. And so if you can just start with something, to Martha's point, $500, and then do some recurring contributions to it, you'll just be amazed over the years how much this compounds over time. And so we've taken an incredibly complex topic like investing and global growth and all these different parts to it, and really whittled it down to its most important parts to it. And so when we're going through this risk profiling process, we're really looking to see how much risk are you comfortable taking, what is your risk tolerance, and creating a portfolio that's suitable for you. So again, my portfolio could be different than Emily's or Martha's, but the intention there is really to put you in a portfolio that you're comfortable in for the long term. And then you can then continue to start, again, recurring contributions every week, every 2 weeks, every month, etc. But then over time, you're going to see how easy it is to start investing. And hopefully at that point, you'll feel a lot more confident in your decision making.
Yeah, and I really do. I mean, I went through the process myself, and anyone that I've talked to truly speaks. I mean, they all say it is so simple to go through the process. I think it's helpful for people to see how easy it really is without having to do it themselves, and kind of how those portfolios are created based on their answers to those responses to kind of gauge the risk tolerance and the time horizon that the customer is looking at.
So I'm pulling it up right now. What I'm going to show is the entire creation process. So I'm an Equity Bank customer. So I'm just on the Equity Bank website. You can see going to log in over here to the right. We are fully integrated with online banking. So now I'm going to log into my online banking platform. Again, this is not a canned demo. This is actually my live information. And we can go in and see, here's my account at Equity. I've got my checking account above. Then you can scroll down and you can see this is the Simply Invest tile right here. So if you're a new to Simply Invest customer, you're going to see something a little bit different. It's going to be more of an advert encouraging you to come check out the platform. Because I'm an existing client, we're actually pulling in information from the investment platform into the online banking universe. And so if you just want to say, hey, how's my account doing? I deposited $500 a little while ago. Oh, I've got $850 based on my contributions and returns, etc. You can just quickly see it there. If you do want to manage it, you can come click this Manage an Account, My Account button, and you're brought into our investment platform. What you'll see right off the bat is that it's a very personalized experience. And so the tile on the far left, what we call baseball cards, That's my investment account. I've aggregated some outside accounts. I've got my Capital One 360 savings account. I've got my American Express Delta Sky Miles card aggregated as well. The Marstone Equity Simply Invest account is right here in the far left. I've uploaded a photo of my 3 kids. I've also nicknamed it Triple Threat, which coming off of spring break last week, I can say that's 100% the right terminology for them. But again, it really makes this all about the individual, which is, again, my platform, which is different than other folks as well. So Emily, to your question, we can go over here to open an account. And if you're a new to Simply Invest user, you're actually brought immediately into this page. But because I'm an existing client, I'm brought to my dashboard first. And so here's where we actually go through our risk profiling process. To Martha's comment earlier, really about the barriers to entry that we're trying to break down. For a traditional investment advisory account that has fiduciary responsibilities, it's usually a much higher minimum account size. So it's 50,000, 250,000, 500,000, depending on the institution. We've lowered that all the way down to $500. So Marstone's providing fiduciary investment advice for accounts as low as $500, which is, I think, really great and really truly a financial inclusion tool. We also have a set of portfolios for what we call the Premier Automated Portfolio. That's above $5,000. It's a similar portfolio construction. There's just more options when you have a little bit higher account balance. So we'll start with that. We offer a series of different account types. So you can do retirement, which is your traditional IRA, Roth, rollover IRAs. These are for retirement planning. There's retirement tax advantages to that. You can also just open up a traditional general investing account. So this is your individual joint type account. I'll do individual today. So we go through a series of questions. So there's 9 questions total, where we ask a lot of behavioral finance-based questions. One of the things you'll notice right off the bat is we've tried to remove all financial jargon from the platform. So we're really trying to speak to the individuals the way they want to be spoken to, frankly. We believe people are smart and sophisticated, but not necessarily financially savvy. And so we're trying to remove all the standard deviation, convexity, duration, words that a lot of folks don't fully understand, and treat people, again, in using terminology that they actually understand and want to be spoken to. So which phrase best sums up your overall view of investing? Stocks are not a reliable way to invest for long term. In investing, it's easier to lose than to win, all the way down to investments generally go up over time, so set it and forget it. Next, how much investment risk are you comfortable taking? Barely any. I'll dip a few toes in the water, all the way to go big or go home. So again, very plain language, trying to get the point across pretty clearly. I'm a total behavioral finance nerd, and so I love these questions next. So this is from the work of Amos Tversky and Daniel Kahneman. So we incorporated prospect theory, game theory questions to effectively gut check to make sure that the person's answering correctly. So there's really no right or wrong answer throughout this entire process. It's only what's right or wrong for you. And so these questions really help ensure that you're actually answering the questionnaire appropriately. Next, we ask, how would you react if the portfolio dropped in value by 10%? I can't lose any more, sell everything, sell a little just to be safe, all the way down to invest more. You'll notice also to the right, we're explaining why we're asking these questions. So we're preparing and helping and arming that individual. So even if they're a total financial novice, they can understand why we're asking these questions in the first place. So similar idea, it's your portfolio drops by 20%. How important is this money to your daily life? This next section is completely optional, but we've found a lot of individuals who want to vote with their dollar and invest alongside their beliefs. And so somebody can say, hey, I want the classic portfolio. This is built primarily towards financial returns. A lot of people say, hey, I actually want my portfolio to have a socially responsible bent. So I can select that, or technology and AI innovation. These are, again, entirely optional configurations, but it enables that user to have more of a socially responsible portfolio or composition in their overall risk profile. I would say, again, just that this is just not actually override someone's risk profile. Someone is a moderate investor, saying they want to invest in tech and AI innovation will not all of a sudden put them all into Tesla and other tech enabled companies. It puts a portion of their portfolio into these interests. And so there is, your risk profile remains consistent, although the composition changes a little bit. Lastly, time horizon, how much do you need within the next 3 years? So really 9 steps, no heavy math, no jargon, and questions that only you can answer appropriately. Our goal is once you click confirm my portfolio or create my portfolio, that there's a great sense of accomplishment that even a total financial novice or expert, frankly, is able to create a portfolio like they see on TV without having to phone a friend, call a sibling, get a parent involved. So you can see this risk level is 5. We're trying to create, again, using different parts of your brain. So if you're drawn more to colors and graphics, you can see the 3D cube to the left. If you're drawn more to numbers and details, you can click the View Holdings button. Here's where we actually show you the asset allocation and the holdings of these portfolios and these securities. And we also have a plain language portfolio strategy below. These portfolios are all built for long-term global growth. And so they are all configured with low-cost passive index ETFs. So our team has created these portfolios. You'll see a lot of iShares and Vanguard represented in the holdings themselves. So what that means is that these are all, again, low-cost ETFs and investment vehicles that have very strong tax advantages to them. Our team creates these portfolios. We then, once the client is invested in them, we then monitor them every day. So we run a rebalancing engine across all of our accounts to make sure that you are in your stated risk profile. So this is risk profile 5. One of the things I think is really cool, and again, our goal here is really to ensure people are learning while they're going throughout the process, but without handing them an investing 101 textbook right off the bat. So an individual can come and say, oh, I appreciate you put me in risk level 5. I'm actually kind of freaked out seeing who this portfolio is right for, some of the risk associated with it. What happens if I'm more conservative? So the portfolio actually reconstitutes itself on the fly. You can see how the holdings change, the portfolio strategy changes, who it's right for changes. And so someone can actually come in here and learn which is actually right for them. You also see just there's a big bright yellow banner saying this risk level may not align with your previous selection, and that's totally fine. We just want to make sure that the individual knows what they're investing in. So what we've seen people play with this a lot and like that functionality. So I'll just pause there, Martha and Emily. Is there anything else about this portfolio creation process you think would be interesting to learn about?
I think despite us trying to use as little jargon as possible, we still live and breathe in this world, so we do tend to use some jargon. So I think, Chris, just diving into, unless Emily, you have a different topic, but I see equities here, I see fixed income money market alternatives. Can you just dive into a little bit of, and then when you were going into the holdings, what is an ETF? Why is an ETF? Why did we choose an ETF? A little bit about that.
When you look at these holdings, so equities is another word for stocks, and so that's when you hear about Alphabet or Meta or Tesla. Those are actually companies, right? And so they all have stocks. They're all publicly traded. When we look at this, instead of trying to be stock pickers and say which company is going to outperform, we invest in global ETFs. And so Vanguard's total stock market ETF is a great example of a ETF, which is an exchange traded fund. So it is the same type of structure as investing in a stock, but actually instead of it being one company, it has 3,000 plus 4,000 companies that make up that overall ETF. And so by investing in one share of Vanguard's total stock market ETF, you have exposure to all 4,000 companies. That's really a great way, in a low-cost way, to get a lot of diversification. So I don't need to be an expert in all 4,000 companies and decide which ones I think are going to be winners or losers. It enables me to have an exposure to the entire U.S. equity or U.S. stock market itself. Similarly, if you look at this, so this is a heavy weighting towards the U.S. stock market. We also have emerging markets and international developed markets. So this is a global stock portfolio, which is made up of these 3 ETFs. When you think about fixed income, those are the more traditionally conservative securities. They are bonds. They don't have typically the amount of volatility or market movement that you see from stocks. Those are very heavily interest rate reliant. Think of it as a fixed income or a bond, similar to a CD in a way. It's for a defined period of time where you get a certain interest rate and payment for it. There's a lot of different shades of that, of course, but more traditionally, the plain vanilla version is what I'm referring to. So we have a number of different vehicles within this. So one's an emerging markets bond ETF. One's more of a short-term treasury bond ETF, U.S. investment grades, corporate bonds, as well as high-yield corporate bonds. So you can see there's different weightings associated with them. The U.S. investment grade corporate bond is the more traditional for investment grade securities, which is, I would say, the higher caliber of companies out there. So again, think of a company like a Google, who's a very well capitalized, very well run, has a lot of great cash flow. They are a less risky company, and so they are what's deemed investment grade by the ratings agencies.
I think that this highlights too, just going back to the original question of why simply invest, like why investing in this way can be really beneficial. I mean, Chris is a portfolio, as you can probably tell, a portfolio manager by background. So he knows a lot about what he's, obviously what he's talking about and able to explain all this. A lot of people don't know that. And so I think coming in and walking through this, like, and kind of knowing someone's behind this, it's not, I don't have to know about all 4,000 companies. I don't even need to know, frankly, what an ETF is. It's great too. And I think we really believe in educating the user and learning as you're going through this process. But I think, Chris, you're just showing your level of expertise, which is amazing. And then why investing in this way is so simple, because you as the user don't actually need to know all this stuff. You can say, hey, I'm getting a really balanced portfolio. And I know that there's someone behind there that's looking at all these holdings, or sorry, looking at all the ETFs, making sure that they're appropriate, and then doing the trading and rebalancing. Sorry, Chris, I didn't mean to interrupt your flow there, but
Yeah, I think it's a great point. I think we covered most of these buckets.
yeah.
The alternatives just is real estate, commodities, other parts to it. So it's similar ETF type structures, and so that's what makes up the overall asset allocations. I would just say that the weightings change based on someone's risk profile. So if you're more aggressive, you want longer term growth. That means your portfolio will probably go up and down and fluctuate in value more frequently. Whereas if you're more conservative, you're traditionally in more of a fixed income type bond portfolio, which has relatively fewer fluctuations in value, but therefore it likely has a lower return rate historically, of course.
The other question that I get a lot from people is choosing between a general investment account or a retirement investment account. And I typically tell people, I mean, most people have a retirement account of some type with their employer or a Roth, elsewhere. And if they don't, a Roth is a great option. But can you just kind of speak on what a general investment account would be good for a person as opposed to a retirement account?
For sure. So I think you said it really well. A lot of people have retirement accounts, 401ks through their company. There's a lot of great tax advantages to doing a Roth or traditional IRA. For a regular taxable account, those are typically, there's no tax advantage to it, which is why they're just taxable accounts. That's a really great account though for somebody who's not investing for 30 years in the future for retirement, who's investing now for saying, hey, I want to buy a house in 5 or 10 years. Hey, I'm trying to plan for my kids' college. Hey, I'm trying to do this in the future. It's a really great opportunity to do that, to then have your money be able to grow, because the one part about a taxable general investing account is there are no penalties to withdraw your money. And so if all of a sudden a life event happens and you need to pull out half your account, while there might be some taxable gains or losses depending on how your portfolio has done, there's no penalties for withdrawing it. And so it gives you more flexibility. So what you lose in a little bit of the tax advantage, it makes up for in the ability to take your money out the next day without having additional penalties. So it really, I think what you said is right, Emily, that people should think about what is right for them, and having a mix of of assets or holdings that are longer term, more retirement focused is great, as well as a mix of shorter term or at least taxable investments that they can call on more easily if something happens.
But I think too, for people that are a little skeptical about investing, they want to invest, but they're just really not sure how comfortable they are with it or how they're going to feel about that money being invested. The general account offers them a great option where, like you said, you can pull that money out and you're not facing penalties that you would with a retirement account. Although we don't want them to pull their money out, right? The market goes up and down over time, and that's something that you have to understand to kind of, be willing to see that it's down a little bit at times and it will go back up over time. And that's why investing over a long period of time is so important.
I think you said it really well right there. And that actually goes to a really good point that I usually talk about in these conversations, is that traditionally, if you're in college, you might have an economics or a finance professor who says you're a younger investor, you should be fully invested in stocks, which is academically totally right. Over the long term, stocks have outperformed other asset classes. I think the challenge with that, though, is you can be 22 or 24 and be very risk averse. And if the market does drop by 10 or 20%, you want to sell everything, which is probably the worst time to sell. And so it's really all about finding what is the right portfolio for you. And so while it might not be academically appropriate to have you be in a moderate or moderate conservative portfolio because you're investing for the long term, if you're going to pull out and sell everything when things are down, that's not the right portfolio for you. So there's a mix of, what's the right thing for you as a rational economic thinker, but also what's the right thing for you as just a human being, right? And there's a lot of things that also you highlighted too, where maybe there's a life event happens. Maybe I just want to buy a car. I want to have these things where I'm not planning 10 years in the future. I'm planning 3 years in the future. And so in that case, I should be in a more conservative portfolio, potentially.
I totally agree with what you're saying, Chris. And I think, I definitely hear that too, Emily, of about the market volatility and people. There's a lot of uncertainty. There's a lot of market volatility recently, and I think I listened, and I'm sure Chris, you can weigh in on this, but I was at a talk one time and it was talking about if you looked at someone who invested in the last 20 years and if they just if they just sold on 3 or 4 days across those 20 years, their portfolio would be down like hundreds of thousands of dollars had they just stayed in the market. And so I think, as Emily said, volatility happens. There's someone, like we keep saying, there's someone reviewing your accounts, rebalancing those accounts daily. We're making sure that you're in line with, your risk tolerance. And I think the most important thing is to, and Chris, back, feel free to elaborate here, but not to necessarily panic. If you do see that volatility, and really reach out to someone, reach out to us, reach out to, on Simply Invest, you can chat. There's a chat agent there. If you want to talk that through, it does happen. And the important thing is, as Chris just said, when it's down, it's probably arguably the worst time to sell, than actually the best.
But if you are interested in investing, Equity is offering, the first year there's no advisory fees for their first year. So it does allow an opportunity to kind of, test things out and see if you're skeptical, to get into it and see how it goes for you. But I think it's a great tool and it truly is simple, and that's why I appreciate it. I feel like I have a financial advisor just as good as everybody else, without having to have that big minimum. So I appreciate all of your hard work and that you guys put in on the backside of things, and I think it's really cool to see.
We appreciate the partnership, Emily. I think it's some really great things that are coming on the works with Earn with Equity and all the other things. So it's been a really great partnership. We're excited about the opportunity to keep collaborating. And yeah, I think Simply Invest is a really great platform for a lot of folks. And so hopefully people will check it out. I think it was a really great idea that 12 months of advisory fee free offering to really enable someone to come through. There's also just the way to come to the platform without even opening an account too. You can come to the platform, aggregate your outside accounts. You can start playing around. You don't need to open an account on day one. You can play with it. And if you want to, if it makes sense, that's fantastic. If not, you want to come back to it in 3 or 6 months, that's totally fine too.
Great. Well, thank you guys for joining me and hopping on here to talk about Simply Invest.
Thank
Awesome.
you. Thank you, Emily.
Bye.